Welcome, everyone. Good afternoon. Thank you for attending today's hearing. My name is Marie Grant. I'm Acting Commissioner of the Maryland Insurance Administration. And this is the administration's fourth regular public hearing in 2024 on specific carrier rate increases for long-term care insurance. And so today's hearing is going to focus on two specific rate increase requests that are now in the individual and group long-term care market before the Maryland Insurance Administration. These include a request from Genworth, a life insurance company, who's proposing a rate increase of 51.5% for policyholders on Form 7046 MD, as well as the State Life Insurance Company proposing an average rate increase of 464.72% for policyholders on forms S600 PMD, S800 PMD, and S900 PMD. In total, these requests affect about 563 Maryland policyholders. The purpose of the hearing today is for insurance company officials to explain the reasons to us in a public setting, and for the MIA to consider whether the proposed rate increases are in compliance with Maryland's laws and regulations relating to long-term care insurance. We will also listen to comments from consumers and other interested parties who sign up. We're here to listen and ask questions of the carriers here today, as well as consumers regarding the specific rate increase requests. And I'd like to take a moment to introduce the folks who are with me from the Maryland Insurance Administration on today's call. So we have Brad Bobin, our Chief Actuary, Jin Shin, Senior Actuary, and Craig I is here with us as well. And I'm going to go over a few procedures that we'd like to follow today, just in terms of housekeeping. So when it comes time for public comments, we'll first call on members of the public who are registered to speak in advance. And to the extent that time and technology permit, we'll also hear from unregistered participants who access our webinar platform, or who we don't have anyone here in person today. So folks who join. And then if using Zoom, please feel free to communicate with us through the chat function. And then, with the exception of MIA staff, want to reiterate that this hearing is not a question and answer forum necessarily. We receive comments from interested parties. We'll receive those in writing and we'll review them. Some of which we've reviewed in advance of this meeting, and then we'll also keep the record open for one more week until Wednesday, December 25th, for additional written testimony. The video of today's meeting, as well as all written testimony submitted, will be posted on our website on the long-term care page. That can be found by clicking on Consumers, the tab at the top of the homepage, and then clicking the long-term care link. And to help ensure excellent sound quality throughout the hearing, we ask that you please stay on mute unless you are speaking. And also, anytime before speaking, if you can please restate your name clearly, that would be a great help to us. And we'll be asking the carriers to speak first regarding the rate requests, and then afterwards, interested stakeholders, should they be in the meeting, will also be invited to speak. I'm now going to turn it over to our Chief Actuary, Brad Bobin, to say a few words about the look that we take at rates in Maryland law regarding these products. So, Brad?
Thank you, Commissioner. Yeah, I mean, on a high level, I just wanted to, talk about these rate increases and put them in context. The rate increases that we're seeing today are very significant magnitude rate increases, but the rate increases of a high magnitude are seen across the entire long-term care industry. This has been an industry-wide issue from mispricing that first started back in the 90s, and insurance carriers have missed on a number of important assumptions, and these assumptions were set for a 50 to 60 year time horizon. So that makes every miss even more sensitive. Across the industry, carriers consistently predicted that mortality would be higher than it was. And so lower mortality leads to higher long-term care claims. And then lapse rates. They also over-predicted lapse rates and thought that members would lapse at a higher rate than they currently were. So the combination of mortality and lapse rates means that there's a lot more members that are living long enough to go on claim. And then also on the assumptions that missed were morbidity, which is the magnitude of the claim, the length of an average claim, and unit cost, the cost of an average day of service, either at a hospital or at a home facility. And then additionally, interest rates have been a miss that have impacted many carriers. So a combination of all these factors have led claims to be literally multiple times higher than carriers originally predicted when they set rates. And so that's led to, really large losses in this long-term care industry. So when we are looking at the long-term care filings, we're evaluating those losses and we're balancing them against, the need to maintain solvency, the need to maintain the ability to pay claims. Most of the filings that we review have loss ratios in excess of 100%. That means that even after our approved rate increases, that more in claims are being paid out than are being collected in premium. And so the goal for a lot of these long-term care blocks that are closed and that are, underpriced is to bring it back to break even. So, we're not looking to give carriers a profit margin. We are not looking to, build in extra conservatism. We're just trying to bring things back to break even. And one important thing that is constraining us in which we, which all of our rate filings are subject to, is we have by regulation a 15% annual limit on rate increases. So that's the most we will approve for 1 year. We will consider approvals of rate increases higher than 15%, phased in over multiple years. But the 1 year 15% rule is firm. I think that's everything I wanted to say, Commissioner. So if you would like to carry on.
Great, thanks so much, Brad. All right, so now I will call on the carriers and I'll allow them the opportunity to discuss their pending rate requests with the MIA. So first I have Genworth.
Thank you. Good afternoon. My name is Alex Baczynski. I'm an actuary in Genworth Life Insurance Company, or GLIC's long-term care in-force business unit. I am in good standing with the Society of Actuaries and the American Academy of Actuaries, and currently chair the SOA's LTC Section Council. Commissioner Grant, thank you and the Maryland Insurance Administration team for holding today's virtual hearing and for providing GLIC and our certificate holders an opportunity to discuss certificates issued under certain long-term care insurance policies which were issued to employer groups based in Maryland. I'd also like to thank all the certificate holders for your interest and participation. GLIC understands that your long-term care insurance coverage is important and welcomes this opportunity to participate in this hearing. We understand that our ability to support, service, and protect you, our certificate holders, is of absolute importance. We take this very seriously and affirm our commitment to being there for you, for our certificate holders when they need us. GLIC has been selling long-term care insurance in the state of Maryland since 1978 and currently provides coverage for approximately 26,000 Maryland insureds and approximately 1 million insureds nationwide. I'm here today to speak specifically about our current long-term care premium rate increase filing, which is pending with the Maryland Insurance Administration. GLIC understands premium increases can be difficult for our certificate holders, so we are committed to providing information that explains why rate increases are needed. We also want to discuss the various options we offer our certificate holders and the ways we assist each of you to make informed choices about your specific LTC insurance needs. GLIC is currently seeking a rate increase on our 7046 employer group product. It is the only product with a current pending filing in Maryland, but we will continue to seek rate increases on other products in Maryland and nationwide. When we price this policy form, we utilize professional actuarial judgment to develop assumptions that look forward as many as 60 years into the future. In keeping with our actuarial precepts and standards of practice, GLIC employs our best efforts to complete a thorough professional assessment at the time of original pricing and as we evaluate the blocks on an ongoing basis. Since this policy form is priced, claim information, which informs our assumptions, has increased significantly for GLIC. We have seen that claims continue to cost more and occur with higher frequency than originally anticipated. Yet we are sensitive to the impact these rate increases have on certificate holders, and GLIC is sharing in the cost of these necessary rate increases. We've stated publicly that all proceeds from approved LTC premium increases would remain in GLIC and be used for the sole purpose of paying LTC claims, and that none of the benefits from approved LTC premium increases would ever be paid to Genworth Financial, its shareholders, other stakeholders, other than GLIC Insurance. These blocks of business are being managed solely for the benefit of insureds. It is our intent to act in a timely manner and work diligently with regulators to obtain approval for the full amount of the proposed rate increase, with the understanding that delays can lead to a larger ultimate increase. As it relates to the specific rate increase request at this time, GLIC issued certificates through Maryland-based employer groups from October 2000 to October 2016 under policy form number 7046MD and certificate form number 7046CERT-MD. We are seeking a premium rate increase of 51.5% for all certificates. Acknowledging Maryland regulation, GLIC would be willing to implement the requested rate increase over 4 years with no more than a 15% increase in each year. This rate increase will impact approximately 323 certificates. This policy form has received one prior increase of up to 21%, which was implemented over a 2-year period so that no increases exceeded 15% in any single year. GLIC will continue to evaluate whether additional rate increases will be needed as experience emerges. Premium increases result in a very important and impactful decision for many certificate holders. We know this because we talk to our customers every day. To support our certificate holders, we have a dedicated team of specially trained customer service representatives whose sole responsibility is to take calls related to rate increases. Our customer service representatives are ready and willing to help our certificate holders understand their options so they can determine the best course of action for their individual situation. We also have a website that provides certificate holders with helpful information on why rate increases are needed, options they may have, the value of coverage, and frequently asked questions. We continue to offer certificate holders subject to a rate increase with a variety of options. They can choose to pay the full amount of the rate increase and maintain the current level of protection. From overall nationwide experience on the rate increases we have implemented since 2012, even with a variety of options provided, we have seen that approximately 43% of our insureds choose to pay the higher premium as of October 31st, 2024. Or instead of paying the full increase, our certificate holders can make customized benefit adjustments to find the right balance of affordability and protection for their individual situation. For certificate holders who decide not to pay any future premiums and who do not otherwise qualify for another option to maintain their coverage while ceasing to pay premiums, we voluntarily offer a non-forfeiture option that equals a paid-up certificate. With this option, if the certificate holder becomes claim eligible, GLIC will reimburse eligible expenses up to the amount of premium paid, minus any claims that we previously paid. In addition, a certificate holder will still have access to the care coordination services our company provides. We are also expanding our Live Well, Age Well wellness program to reach more insureds early in their claim journey. Since 2022, our clinically trained team has offered one-on-one coaching and support for policyholders nearing an expected claim. We've recently introduced daily living aid kits that may assist with key risk areas like fall prevention and home safety. These services are available to policyholders at no additional cost. Currently, this program is available to certain policyholders within our Choice 1 product. We've seen strong engagement and a very high satisfaction rate nationwide, and we plan to expand our Live Well, Age Well program in the future. We introduced the Care Scout Quality Network, or CQN, in 2023 and have expanded to many states, including Maryland, this year. The CQN is the first network of its kind and helps consumers find high-quality care with preferred pricing. The CQN consists of a diversified network of long-term care providers who have undergone a thorough assessment. Currently, the CQN is only available to our individual products, but we are planning to expand to our group products in 2025 and beyond. I hope that the comments today have demonstrated that Glick actively manages our business to try to ensure that we will be here for our certificate holders when they need us most, to make sure we are available to provide the answers you need and to pay eligible claims if and when those needs should arise. Through 2023, Glick has paid over $29 billion to our insureds on nearly 369,000 claims for eligible long-term care benefits. Glick is committed to keeping our promises to our customers and paying all eligible claims. But again, actuarially based premium rate increases or policy adjustments are important to our ability to do so over the life of these certificates. Glick is in a unique position relative to other carriers with a material LTC concentration. Glick has over 60% of total current reserves dedicated to LTC and expected to grow to more than 70% by 2028. As I have previously noted, all proceeds from approved LTC premium increases will remain in Glick and be used for the sole purpose of paying LTC claims. None of these benefits from approved LTC premium increases will ever be paid to Genworth Financial, its shareholders, or other stakeholders, other than Glick Insurance. In fact, Glick last paid a dividend to our holding company in 2015. In conclusion, Genworth remains committed to working with the Maryland Insurance Administration to implement actuarially justified rate increases in a reasonable and responsible manner, keeping in mind certificate holder interests and concerns. Commissioner Grant, Genworth appreciates the opportunity to participate in today's hearing. I'd be happy to answer any questions from you or members of your team.
Great, thank you so much. Let me open it up to the actuarial team and see if there are any questions.
Yeah, thanks, Alex, for your testimony. One question I had is if you could briefly describe the difference between employer between group long-term care and individual long-term care. Is there any kind of employer contribution involved, or was it just marketed through employer groups? Are there different typical benefits? Anything you could speak to on that?
Yeah, certainly. There can be a wide array of differences, but at its core, the key difference is going to be in the distribution where, the employer group is going to, receive a policy that's issued to that employer, and then individual certificates can be issued from that master policy to employees. How the employer, contributes to that or coordinates or provides partial or full premium payment can vary across, employer group products and plans. But the distribution through that employer group channel is the key difference, where individual products are sold to individuals through, normal insurance product distribution channels.
Okay, thank you. So you said you had 323 certificate holders. That refers to individual members, right? Do you know how many different employer groups that represents?
I do not have that figure currently, but I will get that and follow up with you later, Brad.
All right, thank you. Jin, did you have any questions?
Yes, Alex, you're requesting a total rate increase of 51.5%, right? And you want to split it into 4 years. First 3 years, 15% max for each year, and then last year, 7.6%. If you add this all up, I think it comes up. I come up with a much more than 51.5%. Am I missing anything, Mr. Alex?
So I wanted to make sure I wasn't on mute. When we agree to do phased amounts on many of these blocks, we do consider the time value of the implementation. So if we were to implement this rate increase all at once, which we understand is impossible based on the 15% maximum, we would see a lower increase necessary to get to a comparable financial position if we were to phase this in. So the phasing does result in a slightly higher cumulative rate increase, and we have reflected that in the filing.
Okay. And also, your current experience is running, decent, right? Would you say that your actual historical loss experience has been, running well? It's just that your future loss ratio is just so much that the lifetime loss ratio will end up almost 100%. So I was wondering if there are, some uncertainty uncertainty in estimating your future loss ratio based on the assumptions that are, somewhat not very, certain in your assumptions.
It is the case that the historical loss ratios are not significant. That is very typical for any block of LTC where claims are much lower in their iterations, premiums are much higher, and that relationship, over time inverts where claims are backloaded and the premiums have run off. So I do, there certainly is uncertainty, but I think we have strong reason to believe that the higher projected claims are likely given our vast experience we've had, not just on this policy form, but the many other blocks of insurance, both in Maryland and across the nation. So it is the nature with I'd say relatively younger blocks such as this, that you are relying on anticipated changes in future projected claims, rather than largely relying on historical claims in excess of original anticipation. But we do want to try to get out in front of the problem and avoid a position where we're locked into unsustainable positions for the block.
Right. Okay. We sent you additional questions regarding this filing with asking for like a historical rate increase by state and some couple of questions regarding MAE. So if you can respond to those questions, we would appreciate it.
Yes, we are working on those and we'll respond as soon as we can.
Thank you.
Alex, I have one more question. You said that since 2012, 43% of your members have chosen to pay the higher premium, implying 57% have chosen to buy down to a reduced benefit or take an NFO. Do you know what the most popular buy down is?
I won't be able to give exact figures now. I do know that it's I'd say between 15 to 20% of folks elect a non-forfeiture option, and then the rest make some type of benefit reduction while still staying in premium paying status. There's going to be a large variety within that because there are multiple options that policyholders have as far as what benefit feature they may reduce. So what I can do is follow up with a breakdown of what features are most often altered. Would that address your question, Brad?
Yeah, that would address my question. Yeah, if you could follow up with that would be appreciated.
Certainly.
Any other questions? Okay. All right, next we have a state life insurance company.
Hi, thanks for having me today. My name is Philip, a product actuary, and I wanted to spend some time today talking about the state life rate increase that's being proposed. As Marie said earlier, we are requesting an average of around 465% across 3 policy forms S6000, which was issued in Maryland from 2000 to 2004. S8000, which was issued in Maryland from 2004 to 2005, and S9000, which was issued from 2005 to 2007. The increase doesn't vary by issue age or other policy characteristics, and a rate increase is necessary at this time due to higher anticipated future and lifetime loss ratios. For these policy forms, the projected experience is now worse than what was originally priced. And with these rate increases, we're targeting a lifetime loss ratio of 120%. So kind of referring back to what Brad was talking about, a 120% lifetime loss ratio basically means we're agreeing, if these rate increases were approved, in their full amount, we're agreeing to just lock in the loss, paying more claims than premiums on a present value basis. And so if this 120% lifetime loss ratio target were achieved, then no further rate increases would be pursued. And we're kind of trying to be as transparent as possible with this. We understand that there's the 15% limit, but just letting you guys know how bad the situation does look and just kind of giving you guys the full story. instead of just going for 15% and then coming back again without letting you guys know where the experience currently is at. So basically, the current premium levels are inadequate. Therefore, the company is requesting a rate increase to help alleviate the projected experience on the performance of these blocks of business. Insureds will be provided with many options to help reduce the impact of the rate increase. Options such as benefit amount reduction, benefit period, elimination period adjustments, and or removal of riders. Insureds can exercise their non-forfeiture option if they have them, if they're provided by their policy. However, if they don't have the non-forfeiture rider, then they'll be provided a contingent benefit upon lapse option instead, voluntarily. And that's pretty much it. One kind of tidbit I wanted to add. This is more maybe for the actuaries of the department. The lifetime loss ratios are based on projections that only include policies that would be that could possibly be affected by this rate increase. So it doesn't include old, paid up policies or policies that are on CBIL or non-forfeiture. And they're all based on best estimate assumptions. And yeah, I think that pretty much covers everything.
Thanks, Philip. Questions from the actuarial team?
Yeah, if I may jump in, I think this like huge rate increase at this time could have been prevented if we, had a rate adjustment or, some modification to your, pricing, because there was no rate change request during the last 20 years. And I understand this block of business is 100% reinsured by ERAC. So I was wondering how come there was no, rate adjustment request during the, such a long time. Philip, can you
I
answer that?
wasn't involved in the earlier rate filings or decisions on that. So I would actually have to go back and just kind of converse and have those conversations and figure that answer out for you guys.
Okay.
Yeah, and to clarify, my records say that there was a rate increase filed in 2014 for the 7,000 series, but the 8,000 series
6,000.
and the 9,000
right.
series
Right.
do not have any rate filings. But yeah, I mean, the question still stands. It's been a long time since that last 2014 filing was approved for that older series, and the other series, yeah, we'd like to know about the rationale behind waiting so long to file.
Right. Yeah, I did notice that we did have a history, but I was, Jin was talking about just within the last 20 years. So I don't have the answer of that for that offhand.
Philip, how does the benefit compares from one to another? Like is S6000 richer benefit than S9000 or
They should be pretty similar.
similar?
They're just, they're standalone long-term care policies. Yeah, just the pricing are different. So I think I gave the issue years earlier. It's just it's more of a continuation of different policy forms.
Right. Okay. I mean, you have a very modest goal of achieving 120% lifetime loss ratio. Still, that ends up, big loss for the company. But at the same time, with this kind of a 460% rate increase, our policyholders, annual average premium will go from $2,000 to almost $10,000. So that's a big dilemma that we are facing here.
Yeah, it's a very tough situation. The only bright note, the silver lining is, they had those premiums on a discount thus far. But yeah, it's a very tough situation. I agree.
You mentioned that there would be a contingent benefit upon lapse for those without non-forfeiture options. Do you know what that benefit will be?
Let's see. It'll be, I believe it's the maximum of their premiums paid into the policy, minus any claims paid.
Okay, thank you. And I guess on the question about the rate history, the secondary question would be, have you been filing in other states and not in Maryland, or is your rate history consistent and you're just now seeking the rate increases across the country? It's just that's part of what I would want to know too, how we compare to other states.
So there are rate histories for other states as well, and for this one, this current rate increase, it's being done nationwide, and we're targeting that 120% loss ratio after restating the premiums to the state level. So it kind of just we're trying to be as equitable across the nation as possible. And let's see, I don't have the averages on hand, but the magnitude of the rate increases are very similar across the nation, across the states.
Okay, thank you. I'll take a look at SURF for the details.
Philip, again, I'm surprised that this block of business was not managed very proactively, and for last 20 years, wasn't like reinsurance company interested in how it was running?
Yeah, they absolutely were. We do have rate increase history that we have submitted. But yeah, I just don't have the answer for why it wasn't filed in Maryland within the last 20 years.
Okay.
Any other questions? Brad or Jen? Okay. Thank you, Philip. Thank you, Alex. At this point, I believe we had one member of the public who had advance registered for public comment, but we're not sure if he is on the phone. That was Howard Benjamin. So Howard, if you are in the audience, if you can message Craig I or raise your hand on the Zoom function, he'll be able to let you in. Craig, do you see Mr. Benjamin?
I do not.
Okay. So at this point, if we don't have Mr. Benjamin, are there any members of the public that would like to speak that did not register in advance? If so, you can chat Craig I or raise your hand. And I'll just give it a moment to see if there's anyone who would like to share a perspective in the audience. Craig, are you seeing anyone?
I'm not seeing anyone.
Okay. All right. Well, I think with that, then I do want to emphasize, and we'll make sure to put on our website, the record is open, so that if folks didn't get a chance to weigh in today, we are accepting comments in writing through the next week. And our actuarial team is going to be taking a really close look at these requested increases for these products. So just want to thank Genworth Life Insurance Company and State for participating today. Really appreciate it. Always this is a really important part of our actuarial review process, is to have these public hearings on these increases. Let me just, Craig, I'm going to check in with you one more time to see if there's anyone before we go ahead and close the hearing.
No, I'm not seeing any chats or raised hands.
Okay, great, thank you. Brad or Jen, any closing comments that you wanted to make?
No, none for me. Thank you.
All right. Well, thank you so much, everyone. Thank you again for your participation and have a wonderful rest of your day and holiday season. Thank you.
Thank you.
Thank
Same to
you.
you.